Here's something that might surprise you. Most people interact with money every single day of their lives, yet they've never stopped to understand how it actually functions beneath the surface. Not the definition you'd find in a textbook. The deeper mechanics, the hidden framework that quietly determines whether you'll spend your life anxious or finally at ease. And the uncomfortable truth is that the people who profit most from your confusion are the very ones who built the system in the first place. So right now, let's pull back the curtain on what most people never get to see. Start with a basic question. What exactly is money? You've probably heard it described as a medium of exchange or a store of value. Both of those answers are accurate, but neither one is complete. At its core, money is belief. It's a shared agreement among millions of strangers that a number on a screen or a printed piece of paper carries real worth. Modern currencies aren't backed by gold or any physical commodity. Their entire value rests on collective confidence. That is the first truth most people miss. When your paycheck hits your account, you haven't received wealth itself. You've received a claim on wealth, a social contract. The moment that contract loses credibility, the value dissolves with it. History has shown this repeatedly. Currencies collapse not because governments decree it, but because people stop believing. The agreement breaks, and the value simply ceases to exist. Centuries ago, a relatively small group of financiers figured out something extraordinary. If you could manage and manipulate that collective belief, you could effectively control the flow of resources across entire societies. So they constructed the institutions we now take for granted: banks, central authorities, financial regulations built in language too dense for ordinary people to parse. The complexity was never accidental. It was a deliberate barrier. And it worked brilliantly. Generation after generation, people accepted that finance was beyond their comprehension, something better left to experts. When they struggled financially, they assumed personal failure rather than systemic design. Let's get into the actual mechanics. When you deposit money at a bank, that bank does not simply store it in a vault waiting for your return. It loans the majority of it out to other borrowers. This is fractional reserve banking, a system where institutions are legally required to hold only a small percentage of deposits while lending the rest. But the part that genuinely reshapes how you see things is this. Banks don't lend money that already exists. They create it. Each new loan generates new currency in digital form, dollars that had no existence until the moment someone signed a borrowing agreement. Essentially, the bulk of the money circulating in the modern economy is debt wearing the costume of currency. Your paycheck, your savings balance, a significant portion of that exists only because someone somewhere owes a bank money with interest attached. If those borrowers default en masse, the money itself partially disappears. And this leads to the system's most revealing characteristic. It cannot simply maintain itself. It must perpetually expand. Here's the logic. A bank issues $1 million in loans at 5% interest. That creates $1 million of circulating money, but simultaneously creates an obligation to repay $1,050,000. That extra $50,000 doesn't exist yet. It has to come from somewhere, and that somewhere is always more borrowing. The cycle feeds itself. Debt creates the economy, and the economy demands more debt. This isn't a flaw that slipped through during design. It is the design. The architects of this system understood human psychology well enough to know that most people would accept the feeling of prosperity over the reality of freedom. They cultivated a culture where owing money feels completely ordinary, even aspirational. Look at the numbers. The average American household now carries more than $150,000 in debt. The national debt of the United States crossed $37 trillion in 2025. And still, the dominant cultural narrative places blame on individuals. You're told you're irresponsible, impulsive, financially illiterate. But what if the problem isn't personal discipline? What if it's that you've been handed a rulebook with half the pages torn out? Understanding the structure of the game, however, doesn't immediately set you free. Because beyond the mechanics, the system has embedded something far more difficult to escape: the psychology of wanting. Wealth in modern culture has become a performance. The house in the right neighborhood, the car with the right badge, the devices that cost more than most people's monthly income. You weren't born with these specific desires. They were carefully cultivated through advertising, through social comparison, through media that constantly shows you a version of life just slightly beyond your current reach. And the most elegant trap in all of this is credit. Debt is essentially the ability to consume your future income today. It lets you feel wealthy before you are, and then it quietly ensures that you never quite get there. Because while you're servicing payments, you lose options. You can't leave the job that's draining you. You can't take a financial risk on something you actually believe in. The comfort of the things you own becomes the very mechanism of your confinement. The financial industry sharpens this trap with products engineered to extract rather than serve. Overdraft fees, interest rates that compound faster than wages ever rise. Minimum payment structures on credit cards designed so that paying the smallest allowed amount keeps you in interest indefinitely. The confusion surrounding these products isn't the result of complexity for its own sake. It's confusion as a business strategy. When people don't understand what's happening to their money, they absorb the loss quietly and move on. Now consider how people operating at the top of this system relate to debt differently. The distinction is not income, not intelligence, and not luck in most cases. It's intention. When most people borrow, they borrow to consume. A vacation, a vehicle, a lifestyle upgrade. The debt increases while the underlying asset value either stays flat or declines. When someone financially sophisticated borrows, they borrow to acquire a rental property, equity in a business, a stake in something that generates returns. Their debt rises, but so do their income-producing assets, often faster than the cost of borrowing. The interest paid on those investments is frequently tax-deductible, meaning they are using pre-tax money to build wealth while ordinary earners use post-tax income to pay for things that depreciate. It is the same financial instrument producing opposite outcomes depending entirely on how it is aimed. Compound growth sits at the center of this divergence. An investment of $10,000 growing at 10% annually becomes more than $450,000 over 40 years. The math is undeniable. The obstacle is that the math requires a starting position. It requires capital that isn't already committed to debt obligations. Generational wealth solves that problem for some before they ever enter adulthood. Their assets are already appreciating while most people in their 20s and 30s are still trying to get out from under student loans and car payments. The race begins at different starting lines and is then described as a test of individual merit. So here's what all of this should do for you. It should not make you feel powerless. It should make you feel precise. Understanding that the system was built with specific incentives and specific beneficiaries means your financial struggles are not evidence of personal failure. They are the expected outcome of participating in a structure that was never optimized for your benefit. That reframing matters more than most people realize. Because self-blame keeps you passive, keeps you consuming to compensate, keeps you too exhausted to ask harder questions. Clarity, on the other hand, creates space for different decisions. You cannot fully exit this system. Your rent, your groceries, your taxes all flow through it. But you can stop participating in the parts that serve it at your expense. You can resist the pressure to project a wealth you haven't built. You can use debt selectively rather than habitually. You can start, even slowly, to move money toward things that grow rather than things that depreciate. None of this transforms you into a billionaire, but it begins shifting the relationship. Instead of spending your life working for money, you start building a life where money does a portion of the work for you. That shift, modest as it might sound, is the actual foundation of financial freedom. And now that you understand the real rules of the game, the next move is yours.